If they're ready in the next 30 days, we lock in an opportune time. If someone's looking to purchase here, they're looking at real estate in Port St. Lucie with you, Lee, in the next 60 to 90 days, we can do what's called a lock and shop. So we can actually lock an interest rate, which is kind of a unique scenario. We can lock a rate without even having a home yet. And so with a full application, we can lock the rate. You're set. You know what your debt ratio is. You know what your interest rate is, and how that will affect your overall payment. And that way, you're not priced out of the market in the event the rates go up. Some people, it's knocking them out of qualifying range, frankly. And above the 90 days, we can lock out up to 180 days, a full 6 months.
Welcome to another edition of Tuesday Tips with Brent and Lee. If this is the first time you've been to my channel, my name is Lee Brickey, and here we talk about real estate, money, and mortgages. And we're doing that today with Brent Starts from Unitas Lending. Last week, mortgage rates hit 4.6% in one day. So you're reading the news right now that rates are hitting 4% or close to 4%. So we want to cover that with you also. But if this is the first time you've been to our channel, please don't forget to slap that subscribe button, ring that notification bell so you don't miss any of our videos. We put up these videos every single week, and we have our Tuesday tips on Tuesday. So what do you think about the rates jumping as much as they have over the last couple of weeks? Because there's a lot of talk about the Fed is going to stop buying back bonds March 1st, and then they're not going to start buying back bonds anymore because that money has to come from somewhere, and they don't want to creating more inflation for 2023, because right now they're saying we're already looking at more inflation if we don't get some of this money out of the market. So what are you thinking, about the rates and where they're going to be landing here?
Yeah, the Fed has several tools to work with. They're going to raise the Fed funds rate, the rates that banks borrow from each other for overnight funds to reconcile their accounts. That's the first thing that they raise, and that's what people hear as far as the Fed raising rates. The second thing you mentioned is very critical, Lee. The Fed is buying bonds, and so when they're buying bonds, they're creating a market, right, artificially. So they're the largest buyer of treasuries and of mortgage bonds. And so as they, stop or slow down, they're actually planning to taper the number of and the amounts that they're participating in these auctions for bonds, which reduces the supply of dollars going into it. So rates will have to be increased to attract dollars from institutional investors, your state farms, your insurance companies, your institutional investors, pension funds. Those are the primary buyers of those mortgages, and they're going to have to raise rates to attract those mortgages that are in process. Your mortgage is someone else's investment, if you will. So to track those dollars to fund your loans, the purchase of your home, they have to raise those rates to make it more attractive than, say, buying Apple stock or what other investments they want to invest the pension holders' assets into. So that's how that market works. So by reducing the dollars, that'll force rates up.
And what's your reasoning for all this? The rates fluctuating like they are up and down just dramatically?
Yes, the printing, all the stimulus, the printing money, that's inflationary, right? So you have more dollars out there. There's 40% increase in M2 money. We've talked about that before. In other words, dollars are in quickly accessible funds, checking, savings accounts, that type of thing, where those dollars are chasing too few goods with supply chain issues and everything. So it raises prices. And then what we have is, labor inflation as well, wage inflation. And so increasing rates tends to taper that, to knock that down before it becomes out of control and spirals into, hyperinflation, which is a kind of a bad scenario that the Fed's trying to avoid that inflationary, especially a hyperinflation, and to keep employment. That's their mandate, is to keep the recession and inflation balanced. So that's the goal.
But with the rates jumping right now, that has nothing to do with the Fed. It's the bond going up and down, correct?
That's exactly right. A lot of people think the 10-year treasury is where, what sets mortgage rates. Actually, it's the Fannie Mae bond that we watch in real time, by the way, so we can lock rates at opportune times. That's a real key thing that we do that's different. But the treasury, the 10-year treasury, mortgage rates tend to follow the 10-year treasury as far as the going up or going down. It's a very good, because it's a similar to the average mortgage, might be held for an average of 10 years, right? And it's relatively safe. The treasury is backed by the federal government. Mortgages are backed by real estate in America, U.S. real estate, which is a highly regarded asset, globally. And so it tends to follow that trend, but it's not attached to it. The rates are attached to and driven by the Fannie Mae bond.
Okay, so what I'm trying to get at is, so, buyers are seeing these rates go, 3.6, 3.8, 4.6, then drop down to 4%, then drop back down to 3.6. I mean, this is all happening within 30 days because we have a lot of people coming into town buying in the summer times, or right now you have the tax season. So after tax season, the market usually takes a big jump because people have some cash in their pocket. They filed their taxes, they've got their rebates now. So where do you see rates, landing this year? Do you see them continually going up and down all year long? And then for guys like you, do you just have to watch the market and lock at the right time, or do you feel that we'll get some stability?
Well, that's a great question. That's the big question. How much are interest rates going to increase? There's no question they're generally on a trend of going up. Right now, the last 3 or 4 days, there's been a little bit of a correction. We're trading in a channel. The Fannie Mae bond is trading a channel. It's up towards the top of that channel, which is actually reducing rates. There's a inverse relationship between the bond in price and interest rates. So following that, we've had a few good days. So tomorrow, actually, it's President's Day today, the date of this recording, Monday, the 22nd of February. But tomorrow rates should be much better than they were, say, a week ago. And so we watch it in real time, but generally speaking, interest rates are going up. I think by the end of the year, we'll see rates possibly in the mid fours. And we'll see if that kind of levels out and stabilizes in that territory. But I think that's where we're headed. The telegraphing from the different Fed governors, basically they were throwing out, before they did anything, before they tapered purchases of bonds, before they increased the Fed fund rates, one bit, they were putting it out there that was taking the place. So the market's already adjusted that into the March Fed meeting, by the way. So we've got that pretty much baked in. So from there, it's just going to be additional news. Geopolitical news is a big deal right now, what's going on in Ukraine and Russia. So that instability spooks the markets. They move out of equities, stocks, and move towards the safety of bonds. It's a safe haven, treasuries, mortgage-backed securities, that type of thing. So that's driving it right now. That's the news cycle that's running rates right now.
So what is your advice for anyone that's looking to buy a home this year? What can you do for them? What's your advice for them right now? No matter, if they're looking to do something now, they're looking to do something summer, if they're looking to do something the end of the year, what's your advice as far as, getting them set up for a mortgage, getting them into a mortgage? There's some options on locking, things like that. So throw your advice out there.
Oh, great. Well, I'll tell you what, people are in different stages. If they're ready in the next 30 days, we lock at an opportune time. If someone's looking to purchase here, they're looking at real estate in Port St. Lucie with you, Lee, in the next 60 to 90 days, we can do what's called a lock and shop. So we can actually lock an interest rate, which is kind of a unique scenario. We can lock a rate without even having a home yet. And so with a full application, we can lock the rate. You're set. You know what your debt ratio is. You know what your interest rate is, and how that will affect your overall payment. And that way, you're not priced out of the market in the event rates go up. Some people, it's knocking them out of qualifying range, frankly. And above the 90 days, we can lock out up to 180 days, a full 6 months. To assure folks that home that they're building, they're going to be able to close on, and quite possibly the decision to sell their current residence. They have to know with some certainty where their payment's going to be to qualify, and to have the peace of mind knowing rates aren't going to go up drastically. So we have the ability to do that up to 180 days.
Great. And that's really important right now, especially for anyone that's looking for new construction or looking to buy new construction, because most of the builders now are only blocking 30 days. Now, there's some, news is coming down the grapevine that maybe that's going to change, but right now it's only 30 days. And, so if you're looking at, if you're building a new home right now, if you're in the market to buy a new home right now, this is a good plan for you to, maybe reach out to Brent or a mortgage broker in the area that you're in and get a lock and shop or lock that rate on that new mortgage, that new home mortgage, just in case. And I always like to tell people, Brent, that when I talk to them, especially our clients, go ahead and give you a call. Even if the lender for the new construction, comes in and says, hey, we'll match that rate or we'll do the same, because a lot of these builders are giving money back. But if you're getting 5,000 to 6,000, 7,000 back and you're paying a full point more, it's really not justifying that extra cash back. Especially, we just ran into the situation where the builder wanted an extra $30,000 from our client, and she was to get her in her debt to income, where she went with you through UWM, and they were able to take extra income that the lender for the builder wouldn't take. So she ended up not having to spend that extra 30,000 down on the house, which way more than covered the $5,000 or the $7,000 she was getting back from the builder. So Brent's helping out a lot of people with that right now. And just to firm that up with you, Brent, you're not going to be mad at them if they actually use the mortgage company with the builder at the very end. You're just here to help, correct?
That's exactly right. We simply run the numbers, and whatever's best for our client, that's what we're going to direct them to do. In that instance you brought up, we're able to be, at the end of the day, it was in all home. So paying more in the rate for 30 years makes no sense in that situation. But in others, it makes sense to take that credit. And if that's the way it goes, that's great. Whatever works best.
So that's all we have for you today. If you have any questions or comments, leave them in the comments section below. We'd love to hear from you, and we'll answer your comments on the next Tuesday Tips. And also, if this is the first time you've been to our site, please don't forget to slap that subscribe button right there, ring that notification bell so you don't miss any of our real estate tips and tours. And you can watch our next video on the taxes in Port St. Lucie right there. And if you would like to watch our home tours, you can do that right there. Be kind to each other, and we'll see you next time.